Good evening and welcome to the Capital Market. I'm Edidi Ongiwang. The Nigerian debt market has been faced with a series of challenges, most of which were triggered by the worst pandemic in human history. Its prospects in attracting foreign portfolio investors were dampened as macros on Nigeria's economy revealed a downward trend in the market, and this trend has only worsened in the past month. Well, joining me now to talk more about the fixed income market is Babajide Sholanke, a fixed income dealer at FSDH Merchants Bank. Good evening, Babajide. Thank you for coming on the program.
Thanks for having me.
So the Minister of Finance, Budget and National Planning, Zainab Ahmed, recently urged foreign investors to take advantage of opportunities in Nigeria's fixed income market, saying that the Nigerian economy remains resilient despite external shocks it has experienced. What is your take on this?
Well, that's a very optimistic comment, but you must understand that the resilience of the Nigerian economy is very evident in terms of when you look at it from the perspective of macroeconomic indicators that we can look at: inflation rate, gross domestic product, exchange rate, and all of that. We've seen a weakening in the exchange rate, basically. So the exchange rate negates the argument because we've seen a significant adjustment, significant depreciation in the value of the exchange rate, moved from the official rate of 307 to a US dollar to about 380, and the black market is even wider at 400 and above. But in terms of GDP, we've not seen a recession like other global economy has been saying in terms of the United States, the European Union, Japan, China, and the rest of them, which have seen significant double digits, deep in the economic activity. So the resilience is talking about, well, maybe she did put a lot of lights in it, but the resilience can be contested because if you look at it from the perspective of the foreign portfolio investments, how much of it is coming. We've seen a significant reduction in inflow. If the Nigerian economy is resilient, we should see more inflows in terms of more money coming in. So the only indicator that has shown that we're resilient is our GDP hasn't gone into a dip. Exchange rate has depreciated. Inflation is still in double digits. FPI is not coming in. And, the only mainstay of the economy is being whooped, like you mentioned, from the COVID pandemic, which has seen a significant reduction in terms of the demand for crude oil, which has seen, the OPEC and non-OPEC members trying to shut up the prices. Economic activity was significantly reduced because of the lockdown, as economists tried to mitigate, to control the spread of the pandemic. And we begin to see an increase in the crude oil price again because of the opening up of economies. And so I think it's a positive, optimistic, future-looking statement, but the reality on the ground doesn't really suggest that.
Like, speaking about FPIs now, Nigeria, just like other emerging markets, relies heavily on foreign portfolio investment to shore up its external reserves and manage its exchange rate position. But then with FPIs not being, not really partaking in the market right now, how do we manage that?
That's a very interesting question. And, I must commend the Central Bank of Nigeria in terms of the forward-looking solution, to the current, situation that we see in terms of the challenges the Nigerian economy is facing. From 2019, the Central Bank had been forward-looking argument in terms of them controlling the amount of liquidity in the system, controlling people that can have access to the government debt market, and trying to ensure that we have price stability, which is a key mandate of the Central Bank of Nigeria. In terms of the FPI, like you mentioned, we've seen the dwindling in the inflow, and it's understandable, because of the exchange rate concern. And if FPI is majorly concerned about how much of his or our money it can take away when it wants to exit. FPI money is essentially called hot money. They leave as quickly as they go. Unlike FDI, which are brick and mortars, building factories and manufacturing capacity and producing locally. So I had to go into that because it's interesting. The central bank, what they did, I would like to explain it from a broad economic perspective of what is called the impossible trinity. Now, that impossible trinity is saying that no country in the world can manage three macroeconomic variables together simultaneously. So out of that three, they must choose two. And those three are that you cannot have independent monetary policy, you cannot have capital control, and have fixed exchange rate. So what was happening before we saw either the COVID-19 issue, the hit on commodity prices, crude oil prices, the impact on Nigerian federal government of Nigerian revenue, the impact on the exchange rate of the naira to the dollar, was that we saw a change in the central bank dynamic in the sense that they moved away from controlling tool, which was essentially that independent monetary policy, which means that they can set inflation, they can set MPR at the bi-monthly meeting of MPC meeting, they can control inflation without depending on anchoring the exchange rate of the naira on the dollar. And two was that they allowed, then they had fixed exchange rate, which was 307, to the dollar or thereabout before they move it and adjusted it to about 380. So, and they left capital control, which means that you can move in money and move out money without any. So by the time they saw that we had limited inflow of limited inflows of FX by FPI, and we have limited inflow into the external reserve via crude oil because crude oil demand fell because of the global lockdown activity because of COVID. What they did was that they rejigged that impossible trinity and left exchange rate fixing, which is fixed exchange rate, and moved to capital control. So they allowed now to be relatively flexible by moving it from 370 to 380, maintain monetary policy independence, and essentially engage in capital control. So essentially what I'm talking about is that how the central bank have been able to do that is through demand management of FX. What they did is that they now began to ration available FX, so you saw significant FPI that wanted to move out their money. They had to wait a ton. They had to wait a ton. Central bank said, look, we'll give it to you. And they were talking with their creditors, and and it's been successful. And we've not seen the volatile movement in the exchange. So central bank, by and large, has been able to do relatively well, given the challenges that they have.
All right, then, but the current business climate that we have, marred by the impact of COVID-19, has seen more corporates look to the debt market as viable avenues to raise capital. Now, does that reflect the potential of the Nigerian debt capital market and the level of confidence that investors have in the market?
It's tricky again, because you must understand that the confidence in the Nigerian economy or confidence in any company, whether it is debt perspective in terms of the confidence in the FGN debt market or equity market perspective, is based on the future earning potentials of that economy in terms of debt, or the future earning potential of that company in terms of equity, in terms of the dividend that can get for investing in the stock, or in terms of ability of that entity or that sovereign issuing that paper, that debt instrument, whether it's FGN bond or treasury, to pay me back as I went due. Now, the ability of the central bank to federal government, through the central bank, who is the banker of the central government, for the federal government to pay back its debt, it's been significantly not trusted because of the price of crude oil and because of the impact of crude oil price dynamics on external reserve balances, on the ability of the federal government to pay back. And if you say that, is there confidence? There's confidence in terms of Nigeria, of course. Almost 200 million people, large market, cheap labor cost, it's a viable ground for any businesses to come and invest without debt or equity. But in terms of whether the corporate players, are taking advantage, like you said, in the debt market because of the cheapness of the fund.
Okay.
The cheapness is cheap. It's cheap compared with a bank loan. You can raise commercial papers. You can raise bonds at cheaper rates. If you benchmark it to the longest tenured FGN 1 year OMO, which is about 9%, you benchmark it to the Nigerian Treasury bills. You can't even benchmark it to HOMO because HOMO is a liquidity management tool. You have to benchmark Nigerian Treasury bills, which is the risk-free rate, which is about almost of 4%. Without the premium of about 3%, 300 basis points, that's about 7%. Compared with the bank now, it's a no-brainer. It's cheap for you. It's just cheapness, essentially.
So local debt markets are now dominated by domestic investors. Now, with the supply of the new FGN bonds from the DMO reach a record level this year?
It's interesting. Wouldn't you rather borrow from your family than borrow from outsiders? Because your family can have internal arrangement that they can have PTs on you and maybe give you a more fairer repayment period. So that's the joy of having higher domestic investors participate. It's an internal house cleaning something we can actually arrange rather than FPI that want to take out the money and they're putting pressure on the external reserve. So essentially, it's cute. But in terms of whether it will continue to, in terms of the FP, in terms of the COP, in terms of the COP, in terms of the forward-looking, whether it will continue to, it will because there's no other place to put the money. Basically, there's no other place to put the money. And it's not that there's no other place, but there's no other place that can guarantee. Because the debt market is almost a risk-free instrument. In terms of the sovereign, Nigeria will be in perpetuity, unlike an equity market whereby the company can go into solvency, into bankruptcy, and all your equity investment is gone. So it's because of the risk-free nature, it will always be a preferred investment outlets in a time of turmoil like we have it right now.
But speaking about not having where to put your money, now given the amount of ideal PFA cash sitting in bank placements and the weakness in demand for equities, should we expect that buying interest to persist in the near term and drive yields lower in the bond
They will
market?
drive yields lower, evidently,
Okay.
because there's no other place to put the money. You know, there's a higher demand than supply. And once demand is higher than supply, basically you have a depression in price. That's in the depression in price, and because of the inverse relationship in the fixed income market, a depression in yield. You know, there's an inverse relationship between the yield and price. So if price is, an increase in price and a depression in yield, basically, so that huge security, huge amount of money, you know, available idle fund, like you mentioned, in the PFA, which is understandable because the PFAs cannot invest traditionally in the open market operations, treasury bills market, because of the restriction by the central bank. So that money is putting pressure on the Nigerian treasury bills market, putting pressure on the FGM bonds market. And once you have that higher level of demand, that will take the yields down and takes the price up in that market.
Speaking about FGN bonds now, the DMO says it will resume its FGN savings bonds from Monday, that's August 10th. This is good news for investors, right?
Why would you think so?
Because I mean, that was suspended in April.
Okay.
Due to restrictions, due to COVID-19 pandemic, and then the DMO says when the conditions are better or favorable, they would resume trading. So now that they're resuming on Monday, what should we be expecting? Should we expect, investors to heavily partake in that?
Well, I wouldn't. Well, it's nice, like you said, that they're opening shop again for the FGN7 bond, but it's a matter of, in terms of comparing asset classes, what yields are they offering? Compared with Nigerian treasury bills, is it higher? Is it lower? Of course, there will be interest in it. It depends on the preference of the investors. Like I said, there's so much money liquidity out there. Who knows? People may just be interested. But again, you must understand again that in the common week, we have, treasury bills and OMO maturities. That other investments that will be competing with it. There's an FGM bond auction calendar out soon for August and September. So that's several investment, classes
Options,
that will compete with it. So it's fine because people have an array of choices, but that doesn't mean we'll see significant increase in the 7 bonds, given the lower you compare with other asset classes.
Speaking about lower yields, now could you tell us more about why yields, interest rates on treasury bills and bonds have dipped?
It's the same argument.
Okay.
Taken from where we handed it.
Okay.
Demand is higher than supply.
Okay.
The available investments in the debt markets in terms of the categories of the asset class has reduced significantly. Who can participate in the open market operations has reduced. Who can participate, not ordinarily, the PFAs that are big players in the debt market, ordinarily, split their investment either into open market operations or treasury bills. But now everybody's going to Nigerian treasury bills because they cannot participate in the open market operations. It's only FPIs and the banks that can do that. So you still have significant maturities. And, interestingly, we've seen a small maturity in terms of open market operation maturity in the system in July. August, I'm going to say about 800 billion naira. From October down, we're going to be seeing 1 trillion. So we're going to see huge maturities for the rest of the quarter, for the rest of the year. And that, of course, is going to, what it means is that we're going to see higher demand that will take down the yields further.
Okay, so what has been the performance of OMO and Nigerian treasury bills so far?
For the OMO market, in the month of June, what we saw yield hardly moving. Like I said, we saw lower maturity, about 100 billion matured. So there was little or no activity. So the closing rates across the tenors, the 3 tenors for the open market operation, remain the same. For the Nigerian treasury bills market, we saw a significant drop in the yield across tenors, to 1.2, 1.5, about 3, or 2% across the tenor because of the huge demand coming from insurance companies, coming from asset management companies, coming from the PFAs and private individuals that cannot participate in the open market operation.
Okay. So just hold your thoughts there. We'll continue this conversation when we return from this quick break. Stay with us. Welcome back and thanks for staying with us on the program. Babajide Sholanke, a fixed income dealer at FSDH Merchants Bank, is still with us in the studio. Thank you. So just before we went on the break, I just wanted to ask, there hasn't been an OMO auction in about a month now. How has that affected that segment of the market?
Your pent-up demand. Pent-up
Okay.
demand, just means that the demand has to find the source or outlet to be met, and that would be the secondary market, even though there's no auction in the primary market. But what we've seen is that because there hasn't been a fresh demand at the primary market, what we've seen is that because of the liquidity squeeze in the market, there's been liquidity squeeze because the central bank trying to ensure price stability. Stability in particular, the price stability of the two forms is the stability in local prices, which is inflation, which all of us know, then stability in the price of external prices, which is exchange rate, which is what we normally call exchange rate of the naira to the dollar. So the central bank can try to ensure that there's price stability, and they try to ensure that the system liquidity is such that it's not inflationary, has been taking out, sucking out money via the cash reserve requirement, CRR, try to limit the demand, that people will have on goods and services that can generate price stability. So what we've seen is that we've seen limited demand, even at the secondary market, because no fresh fund is coming in. Remember that OMO maturity is what is usually used to bid at the OMO auctions, at the primary market. So if there's no OMO maturity, there's no OMO auction bid at the primary market, people will have to just sell what they have. So what we've seen is that we've seen an increase in yield in the OMO market because people had to create liquidity because there's no fresh liquidity in the system. And the existing liquidity has been taken away by the central bank.
Okay, let's do a quick market review now. How would you say the fixed income markets performed this week, looking at bonds, Nigerian treasury bills, and OMO bills?
The same thing. The same
Okay.
thing. System liquidity is very poor.
Okay.
And because it's poor, people have to create liquidity. The banks have to create liquidity, individuals have to create liquidity, corporates have to create liquidity. And how do you create liquidity when there's no fresh liquidity? You have to sell existing holdings. Okay. So we've seen yields go higher as people try to offload to create the liquidity that's been squeezed by the central bank debit. However, the central bank does intermittent crediting back into the system in terms of the amount of liquidity out of the squeeze it has taken out by CRR sometimes, which is CRR debit, to do some CRR credit. We've not seen a lot of it in recent times. Central bank took out, significant amount at the beginning of the week. So that's all liquidity being taken out in the bond market, in the treasury bills market, which is the NTB for the FGN, and open market operation, which is the liquidity stability tool of the central bank.
So recently, the bond market, we saw the bond market bullish for some time, but then all of a sudden we just saw, that market go bearish. Why the sudden change in the bond market?
It's still, if you look at it, there's a negative yield across board. Negative yield in terms that people are willing to hold bonds or buy government securities lower than inflation rates, which means people are just concerned essentially by preservation of capital, of principal. They're not really interested in the income to be had on it. And that demand you saw in the bond market was specific because of certain level of interest in terms of aggregation of people. Maybe PFAs have to meet certain conditions or certain portfolio limits and investments of free cash flow that they had. But essentially what drives the market is the liquidity level. The liquidity level is low. And that's why I saw that there was no sustained demand, and there has to be a dip along the way because people need to create that liquidity that was absent.
Should we be expecting an increased demand for Nigerian treasury bills due to unmet bids at the last primary market auction?
Yeah, we should.
Okay.
And that is still consequent because we have over maturity next week, about 180 billion. Okay. So that's a lot of money coming in. But again, we must be careful. There's an intricate dance in the debt market space in the terms of open market. Normally, when we have such open market operations, which are injections, because the basic injections that drive the debt market, essentially the secondary market and the primary market, are the open market operations, the FAC injections, FX bid, when it comes in and when it goes out. And once you have over maturity next week, essentially we should see some demand. But that demand may be limited, depending on what the central bank sees to be the liquidity condition that is not inflationary. And they may just come with the CRR debit to suck it out.
Okay. What were the major market drivers this week?
The major market driver still remains, like we mentioned, lack of liquidity. Basically, there's significant FX bid. Like I mentioned, that's a key driver of the equity of the debt market performance. We saw beginning of the week because we had a shorter week in the previous because of the celebration. Okay. So they didn't do. There was an FX bid that was supposed to happen that didn't happen. And the central bank, there was an FX bid, I think, on the Monday, and the central bank took out money. So when that liquidity is taken out, because you can only afford to demand when you have the ability to demand. Ability to demand is a function of income, of liquidity. And when all that is absent, that's why you saw the lackluster performance in the debt market this week.
Okay, so let's look ahead now. What is your outlook for next week?
Yeah, for next week, like I said, we'll see increased demand. There will be demand for debt instruments, essentially because we have almost maturity of about 80 billion maturing, which, like I said, the two key elements you should always look out for market performance will always be open market operations maturities, FAC injections, which is the one that goes to the different states, and FX bid, conditions. So if we have over maturity next week, that means you have some level of uptick in demand. But that demand must be couched, or there's a caveat there, which shows that the central bank have a master sheet. They know what liquidity level is consistent with their inflation rate objective. And once they do take out that liquidity that's expected via serial debit, then we should have some level of better performance next week compared with this week.
All right. Thank you, Babajide. Babajide Sholanke is a fixed income dealer at FSDH Merchant Bank. And to company news now, cement manufacturer Boa Cement has announced a 12.7% increase in its half-year revenue at 101.2 billion naira, up from 89.9 billion naira reported in the corresponding year. According to a statement by the company, its profit after tax also rose by 9.8% to 39.1 billion naira, while profit after tax surged by 13.7% to 34.8 billion naira. Similarly, the company's earnings per share edged up from 90 kobo to 1 naira 3 kobo, with its cement volume up to 2,463 kilotons. Meanwhile, flour mills of Nigeria posted 573.7 billion naira as full-year earnings for the period ended March 31st, 2020, which is an improvement against last year's performance. According to its latest financial report sent to the Nigerian Stock Exchange, the company's resilient performance is due to growth in major revenues from its food, agro-allied, sugar, and support services business chain. The group's pre-tax profit rose from 10.17 billion naira to 17.49 billion naira. After-tax profits increased from 9.9 billion naira to 11.44 billion naira, while it plans to declare 1 naira 40 kobo as dividend per share to shareholders at its upcoming annual general meeting next month. But still on earnings, Nigerian Aviation Handling Company posted its second quarter revenue at 3.57 billion naira, down from 4.8 billion naira recorded as of June 2019. According to its 2020 financial statement sent to the Nigerian Stock Exchange, the group's profit before tax stood at 179 million naira, down from 579 million naira reported in the corresponding year, while also reporting a loss in its profit after tax. The company says its performance shows the impact of COVID-19, which reduced businesses across its subsidiaries. Away from earnings now, Custodian Investments PLC has reached an agreement to purchase 51% equity stake at UACN Property Development Company from UAC Nigeria. In its separate letters to the Nigerian Stock Exchange, the company say UPDC's issued share capital valued at 9.46 billion ordinary shares will be sold in 2 batches. According to the Group Managing Director of Custodian Investment, Wale Oshin, the transaction will provide the company with a platform to capture a rise in real estate opportunities. Meanwhile, South African telecoms giant MTN Group says it's planning to sell part or all of its $243 million investment interest in online retailer Jumia Technologies as it seeks to pay down debt and enter new markets. The telco, which had previously marked Jumia as a non-core business, is reviving plans for a sale after Jumia's shares jumped 142% this year, recovering from a dip in 2019. MTN Group has been disposing of its non-core assets as part of its strategy to reduce debt and drive revenue growth. Meanwhile, reports say no final decisions about the sale have been made public. Well, that's it on the program tonight. Thank you for watching. I'm Edidi Ongiwang. Do remember to stay safe.